not on. I have to see if anybody. Nobody will chime in. It's like sometimes it's good, sometimes it's crap. Oh, there are 4 people on. See my shaving? Okay, so I will see. You got this tomorrow, right? You got it. And I'm not worried about you. So call me tomorrow before like 9:30 or so. Okay. Oh, wait, I'm dropping the dog off. So just do that. And then if you have any last minute stuff, shoot me a text. And then you're going to call me after you get a pass, right?
Yes.
Okay. Yes. Come on. And your Venmo, right? Where's that? I always forget. Okay. Anybody have questions? I'm up to 6 people. I am loved. I'm up to 6 people. And I'm not going to be nice today because I'm tired. I just flew in from Texas. And, boy, are my arms tired. Sorry, it's a bad joke. Anybody have any questions? Oh, look, it's so bad somebody left. There were 5 people on there before.
All right. Thanks, Kevin.
So, see you after this. Then we got the 63.
Yeah, but then I don't know how that's going to work out.
It's easy.
Yeah, but it's like I've only got 6 days to study for.
It's more than enough. Well, I have stuff for it. I'll give it to you. Okay. As soon as you pass tomorrow, I'll send you stuff for the 63, all right? You got this. Oh, yeah. Don't do that. Well, I'm here for an hour or so. Look at that. Oregon. All the way from Oregon. Look at that. Okay. Okay. Row. Okay. So first of all, Tegan, don't worry about it. It's Tegan, I assume. Don't worry too much about the depreciation. I'll talk about it, but don't go crazy on it because it's this. The SIE is not that bad. The top off stuff, there'll be more. So how much time should I spend studying? Okay. So the question is, you have taken some finance courses. The best way to know if you're ready or close is to take that FINRA practice exam. But I would focus on getting through the book once and take the book straight through one time. Read the book straight through if you haven't done it already. See how you do. Take some notes on the on stuff that you're having trouble with. Reread it. Maybe even take a quiz at the end of. Do you have a book? If you don't have a book, it's first of all, okay. I'm gonna get my ADD is gonna kick in a second. Ro, if you don't have a book, you either have to buy STC, Training Consultants, Kaplan, or Notman, or even Past Perfect. Any of those, you have to buy them. You have to get the books. Do not get Past the 7 by Paul Walker. Do not get For Dummies. Does that make sense? Okay. Past Perfect is fine. They go a little mathy for you, but it's definitely good. Okay. So I'm going to go down the order. Okay. Options. If you watch my previous lives, I talk about them a little bit, but I will hit them a little bit. Okay. Okay. Yeah. Okay. Now, let me start with depletion and depreciation. Okay. I'm going to start because I'm going to get my ADD will definitely kick in. Depletion and depreciation. Basically, you can do a write-off. So what can happen is if you have a good, like a truck or a car or a building, the IRS allows you to write off the value of it. So let's say it's $100,000 building, and say the IRS thinks a life is a 10-year life for this building. So what's going to happen is they're going to let you write off 10 grand a year off your taxes. Let's say you make 100 grand a year and you have a $100,000 building, and after 1 year they say the buildings are only worth 90 now. So that 10 grand is what you get to write off you get to lower your income. That's depreciation. Limited partnerships allow you to do that. Depletion is like, say you have oil, say you drill and you find a big pool of oil, and say there's 100 barrels, and you sell 1 barrel. You've sold that, so you depleted the barrels a little bit, so you get to write off the fact that you sold that. That's one of the greatest write-offs ever. Depletion. So depletion is for man-made stuff that as you get older, the value of it goes down, and you get to write off. And what I mean write off means is if you make 50 grand a year and you write off 10, you only made 40. So you only pay tax on 40 grand. Depletion is almost the same thing, but it's for God-made stuff like oil, gas, lumber, gold, silver, anything that has a finite number that if you mine it and sell it, you can't sell it again. So you get to write it off through depletion. That's what limited partnerships kind of let you do, because you could do it yourself. If you had a business by yourself and you just wrote over, and you just had a business and maybe you sold oil or you had a truck, you can lower your income, your taxable income, by doing these write-offs. But as a limited partnership, it's you with a bunch of other people doing the same thing. Don't go too heavy on this exam with the limited partnerships. Top-offs, definitely there'll be questions. The SIE is mostly about, you have to understand that it's a structure that passes through both gains and losses, which means you get the money, plus you get all those losses as write-offs to reduce your income. They are not liquid. They are risky. Now, a REIT and a real estate limited partnership are two different things. A real estate limited partnership is a limited partnership that invests in real estate, and all the money passes through, all the gains and all the losses. So you get to write off the losses, reduce your income. Not liquid, pretty risky. A REIT is traded on an exchange. It's like a stock. So you buy it at market price, you can short it, you can buy it on margin, but it pays out a dividend. So it pays out an income stream of dividends, and it pays out 90% of its income. That's what it has to do at least. Okay? So now, the REIT is liquid. It's like a stock, pays out 90% of its income. A real estate limited partnership passes through all of it to you. So if I have a real estate limited partnership and 3 partners, and I make 90 grand, each person gets 30 grand. But if I also have 9,000 in losses, each person gets a piece of paper that they get to reduce their income by 3 grand, 9,000 divided by 3. That all passes through. The actual partnership pays no taxes. Okay. Kyle, you said you're taking a Friday. How we doing? Shoot me set it on here what you're doing. How's your scoring? Where you're worrying about it? Okay, Ro, you invested on your own, so you kind of know. I'm working my way down the comments. You kind of know, buy stocks and bonds. That's going to help you a lot. It really will. But guys, I can't stress enough, you need to know the risks. One of my old videos talks about it. Interest rate risk, inflation risk, market risk, all those risks you have to know. Find it in your book. Okay. Edwin, you need help on options. Okay. You have weeks, which is good. I will probably go more next week on it, but look at my old videos where I talk about options. It might be last week or the week before. But again, options are just contracts. It's a piece of paper that says, oh, here, Edwin, I get to buy 100 shares at 40. So if you buy a 40 call, you're buying this piece of paper that says Edwin gets to buy 100 shares at 40. You pay $2 for it, which is like 200, but you pay $2 to buy 100 shares. So you pay $2 per share to buy 100 shares at 40. So if the stock goes up, that's awesome, because it's trading at 50. Normally you'd have to pay $50 for it, but because you bought the call, you have the right to buy it at 40. The other way, which is the more confusing one, is a put. Edwin, you buy a 50 put at 2. That gives you the right to sell stock at 50, no matter how low it goes. So even if it goes to 0, you get to still sell it here. So you're bearish. It's just a piece of paper. You pay $2 for this thing that says Edwin can sell stock at 50. The best way to explain it is this. I buy 100 shares at 50. I want it to go up. I'm afraid it's going to go down, so I buy a 50 put. So even if the stock drops, I will still be able to sell it at 50 and not lose any money, other than the premium that I spent on it. Again, look at my older videos. I don't go too heavy into options because they don't go too heavy, and I need to make some money. So that's a lot of my tutoring is on options and for the top off. Okay. Tegan, I'm assuming it's Tegan. I hope it's not Tegan. For a limited partnership, yes. The general partner runs the firm. He does all the signing. You need his signature. And the limited partners, all they do is drop cash. That's all they're doing. They put money in and they go, please do a good job. They're very limited. They don't do anything else, okay? All they do is put money in. Yeah, and some of the books they talk, oh, they can vote in and out. But in this case, it's always about They are very limited in what they can do. They're silent partners. That's the best way to think of them. But they get a percentage. I mean, so if you have 5 limited partners and 1 GP and you make 60 grand, everyone's getting 10 grand. Okay? Now, but you're right. Only the general partner signs. The limited partner just is putting money in. So one of the questions goes, you need to open an account. You need the tax ID number of the partnership and the signature of the general partner. So the general partner does everything again. Okay. Edwin, you said using Past Perfect. I like them. I really do. Their word questions are good. Their math questions will make you doubt your sanity. They're pretty hard, especially on the upper exams, the top off 7 and the 79. Their math is hard. Like they kind of take you on a couple laps before they answer the question. So if you're getting their word questions, you're good. Okay. Now, the next thing, temporary hold. I assume that we're talking about the temporary hold on someone who is either incompetent, over 18 and incompetent, because if they're under 18, the reason we don't care is because they have a custodian, or seniors. So what happens is we're afraid that little old man or little old woman is getting taken advantage of by some young person. Either way. And they're taking their money out. So what they do is if you think that that the person is being taken advantage of, what you put a temporary hold on withdrawals. You can't stop his investments because that's fine. Okay. So you can't stop him from trading or her from trading, but you can withhold the money being sent out, because what happens is you want to make sure that they're not just writing a check and taking cash out and give it to this evil person. Okay. So, again, you can let them trade because that's not money coming out, and you can let them invest. You can hold off. I think it's 15 days. You can hold off from letting them withdraw money because it gets, you want to make sure they're not being ripped off. Okay. Again, Noe, I hope I helped you a little bit with the options with my little rant on that, but look at the old stuff. Again, past perfect options are hard. They're hard for me. I got a 99 on the 7, and I get like mid-80s on past perfect and Kaplan because sometimes they're vague. Okay. Okay, so let's move over. Now we have, okay, the difference between clearing firms and introducing firms. Okay, so Zach, really, again, I'm going to say this a lot. Don't worry about going too deep, but a clearing firm is a firm that does all the back office. They do the settlement, which is sending the money to the other broker-dealer, receiving the shares, giving out margin, holding the shares, doing all the stuff. An introducing broker-dealer is like I have an introducing broker-dealer here. All we do is we take customers. We don't hold their money. Their money is actually held at a clearing firm. We execute the trades or give the orders to another broker-dealer or to the clearing firm. So we're kind of like introducing a customer to a clearing firm. We're the middleman. We get commissions on everything they do. So they'll use the clearing firm to trade, and then we get a cut of the commissions. But we don't have to do the holding the money or the margin or the delivering or the settlement or any of that stuff. But we don't even take money. All we do is get a check from the clearing firm every month for the amount of business we do. That's a clearing firm, does all the back office stuff. Introducing firm does the introducing and just kind of gets commissions based on orders to the clearing firm. Agents are just people who work for firms. Like if you pass this exam, you're a registered rep. Once you're done. If you try to work in a state, what they do is you take the 63 or the 66, and you become an agent of the broker-dealer on behalf of the state. So remember, registered rep is a FINRA term, people who do recommendations and affect securities transactions. Agents is a, for the person, is a state-level term. Okay. Okay. Commission versus markups. Okay. So this is the way I explain it to everyone. I give you an order to buy 100 shares at 50. Okay. You go out and buy it for me at 50. You're not using my order, my money. And then you come back and say, Ken, I'm charging you 50-cent commission. So I net pay $50.50. Okay. So again, I give you an order to buy 100 shares at 50. You execute it for me. You give the order out. You're like representing me, and then you charge me a commission for doing it. You put no money up, no nothing. But net, I paid $50.50. Okay. Now, the next step is if I do a principal, and that's a commission. Remember, ABC, agent, broker, commission. That's big. ABC, agent, you act as an agent, act as a broker, same thing, commission. Now, a markup is when I give you an order by stock at 50, you then either sell it to me out of your own inventory and then charge me 50-cent markup, or you go buy it at 50 and then sell it to me at $50.50, marking it up 50 cents. Kind of like if you go to a restaurant and you buy a $10 bottle of wine, you know that they bought it for $4 and they marked it up to 10. Again, I give you an order to buy 100 shares at 50. You, the broker dealer, or it's the dealer end, will buy the shares at 50 cents in the open market into your own with using your own money, then turn around and sell it to me at $50.50. And that's a markup. To me, it doesn't matter. The customer doesn't care. Okay? The customer does not care. Okay? We okay with that? I think we should be okay with that. Okay? So now, now we go. I think that should help a little bit. Okay. Now, you also asked open versus closed, which I think other people have asked too. An open-end fund is a mutual fund. You buy it at the NAV, net asset value, plus a sales charge. That's the negotiable part. NAV is what the fund is worth. It's actually what it's worth. Open-end mutual fund, you buy it at NAV, they add a sales charge, and then you pay the POP. Okay? NAV plus a sales charge plus POP. Okay? Equals POP. See, it's late. Now, they price that one time a day at the end of the day. So if I buy at 10 in the morning and you buy at 3 in the afternoon, we're both getting the same price. Okay. Now, on a close-end fund, it's still packaged and it's actively traded like a mutual fund. Mutual fund and closed-end funds are both have a full-on manager buying and selling, trying to beat the market. They the closed-end fund trades during the day. So if you buy 10 in the morning and I buy 3 in the afternoon, we're going to get different prices. We're going to get market price plus a commission. Okay. Okay. Now, market. So what happens is if I buy a closed-end fund or an ETF, both similar in that way, I pay market price plus a commission. Okay. So now, a market price plus a commission. So I'm paying, basically you're buying it from other investors. So mutual fund, I buy from the actual mutual fund company. They add a sales charge, max 8.5%, and that's what I pay. Now, if I invest a lot of money, they will reduce the amount of sales charge. It's called a breakpoint. And they have that. That's more in the next exam, but understand there are a thing called breakpoints. Breakpoints are the more you put in, it's a volume discount. The more you put in, the lower the sales charge, but it's still no less than the NAV, which is calculated when? At the end of the day. Now, again, closed-end fund, you buy it at the market price plus a commission. If you sell it, you have to sell it back to the other investors who wants to buy it at the market price, whatever it is, minus a commission. Now, it moves up and back down, okay? Now, Mike G, nobody cares what they buy more of because it doesn't matter. It's most likely bills, but nobody cares. Mike asked, does the Fed buy more or sell of what? Bills, notes, or bonds? It's pretty much bills, but it's not a testable question. Usually on the test, if you say what is most likely to be used, or they're not, that this test is most likely, I just used it, is not going to say what is used the most or this. That's like a subjective question that can't be answered. They will not ask you which will be used the most. Just understand the Fed buys bills to help the economy, and then they sell to tighten it up. I know STC, like I said, I'll get a 99 on the 7, but I'll get mid-80s on this Kaplan and STC because they're kind of vague. I want to go back to this. Now, open-end, NAV plus a sales charge, closed-end, market price plus a commission. The closed-end fund can trade above or below the NAV because it's based on market price. Okay. Now, we kind of know what a mutual fund is now. It's an open-end management company. It's a package where they have an active manager who's buying and selling, trying to beat the market. An ETF is passively managed. What they do is they list a certain number of shares. I'm simplifying it. They put a certain number of shares out there, and they sell them, and they trade in the open market. Very close to the NAV because they're super transparent. You can basically see every percentage, the percentage they have of each security. Where mutual funds, open and closed, they only show you like the top 5, so it's not very transparent. It's actively traded, that's why. Or an ETF, if you type in ETF in Google and look one, there'll be I think it's called positions or whatever it is, or portfolio. You'll see the percentage on everything they have. But again, low fees. Open end and closed end are actively managed, so you're paying high fees. ETF has very low fees because you're not paying some guy to actively manage it. You're paying some guy to once a quarter reallocate it. Okay. You asked about negotiable CDs. Okay. So they don't have to. A lot of them trade. Some trade it. A negotiable CD actually could trade below par. They mature at par plus accrued interest. I don't know if they're the only one. I'm sure there's one or two that isn't. But the big thing about negotiable CDs that you have to know is that you can sell them prior to maturity. But if interest rates have risen since you bought it, you may have to sell it for less than par. If you hold it to maturity, you're going to get your par plus accrued interest. But if you sell it before that, you may get less than par. Or if interest rates go down, you may get more. Negotiable means tradable. Okay. Mike G, you asked the most volatile rate. So let's talk about it. So there are 4 main rates, okay? And I remember, I call it, what is my acronym for this one? Oh, it's Pretty Girls Date Me. Well, I won't tell that to my wife, but Pretty Girls Date Me. So it goes, oh, is that the wrong one? Oh, how about this one? Pretty Boys Drive Ferrari. That's the acronym. See, I have all these things. So prime rate's the highest rate. It's based what the banks lend to their best customers. Like Wells Fargo would basically lend to like the big companies like Macy's and Home Depot at the prime, and that's their base. The broker loan rate is what the banks lend to broker dealers for margin accounts. That's lower than the prime. They still move. They don't move that fast. The discount rate, that's the rate that the Federal Reserve lends to banks to meet their reserve requirement. Reserve requirement is banks have to have a certain amount of money. The Federal Reserve will lend them money if they need to get above that reserve at the end of the day. They're very short-term loans. Again, the only time that moves, if you listen, last year, they were raising it a lot, and then Trump said, stop doing it. You're slowing down the economy, because that is a method of the Federal Reserve to slow down the economy, is to raise the discount rate. That's the only rate they get to adjust. Okay? Okay. It's called broker loan call rate. That's what it's called. So it's the same thing. So we have prime, broker, discount, Fed funds. Fed funds the lowest. That's if banks go under their reserve, they borrow from each other first. Then if they can't, then they go to the Federal Reserve and the discount. If you think about it, it should be the other way around, but they don't do that, of course. So the Federal Reserve offers at the discount rate, and then the Fed funds is a rate that changes every day. It's actually the average of all the different, like it's Nomura borrowing from Bank of America, Credit Suisse borrowing from Bank of America. And that the average at the end of the day is where we are. Okay. The most volatile rate is the Fed funds because it changes every day. Okay. The other ones kind of move like molasses. Okay. 529 versus Coverdell. The 529 is a state-sponsored plan, so it's a muni. I think it's a better plan, but it's not guaranteed. There are no. Here's the big deal. Write this down. 529. No income limits. No contribution limits. Well, each state has their own. There's no age limits. and you can use it for college. There's some exemptions for under college now, but for the most part, I think it's for college and up. And you can put almost as much money as you want in. Even if you're a rich guy, you can put money in. There's no age limit, so you don't have to start doing it at 18 or 30 or any of that stuff. The only problem with the 529 is the investment choices are limited, very limited based on the state. Okay? Now, no LIBOR at all. They don't touch it, other than maybe an offshoot, but no, they're not talking about that. Coverdell. Coverdell is a federal plan. So whenever the federal government gets involved, they put a lot of rules on it. They have income limits. You don't have to know it, but I think it's either 80 or 130. I know that's a big gap, but I can't remember. They have income limits. You can only put in $2,000 a year per kid. And it's one adult, one kid. At 18, it becomes the kids, and he has to use it by the time he's 30. He or she is 30. If they don't, they get taxed. The good thing about both of these is the money goes in after tax, which means you put money in after it's been taxed. But here's the magic. When you take it out and use it for school, it's tax-free. So if I put in $2,000 when the kid's born, and at 20, he takes it out, it's like, say it's $20,000 when he's 20, a wish, you pay no taxes on that $18,000 if you use it for school. Okay, I hope that helps. Now, what can you do after you pass? The SIE, you can do nothing. If you pass the SIE and the top off in the 66, you can work at any broker-dealer. If you want to work at a hedge fund, you don't need this. If you want to work for a commercial bank, you don't need any of this stuff. So again, after you pass the SIE, you are not qualified to do anything. All it does is you can take the next exam. No, by the way, all of you, if you remember one of my older videos, you do not need the SIE to take the top off. They're worthless without each other, but you can take the top off first. Goldman actually does that with a lot of their students. They have they make them take the top off first, so then they're ready, and then they take the SIE. Because the SIE is more straightforward and basic than the top off. And by the way, all of you who are going to pass the SIE pretty soon, I want you to give a healthy respect to the top off. Do not think, oh, I got the SIE down. I have a lot of students that I get them through the SIE pretty easily, and then they go, oh, I got the top off myself. I try to talk to them, and then after they fail, they come back. So it's a little tough. Yes, on the SIE, Kaplan, a lot of people are saying Kaplan's harder than the SIE. They really are. I'm not saying they 100% are, but a lot of people saying that they're a little too detailed. And again, remember, these are sort of detailed exams, but it's not crazy. They're not trying to trick you on every little piece. I wish I could see the Kaplan breakdown. Like, again, I'd say this to everyone, the SIE, you got to know it all. But if you have the STC books, please make sure that you read chapter 14 through 18. It's big. And know the risks. Risks. You got to know the risks. I can't stress that enough. Okay. I think I answered most of them. I kind of went quick through end, but that's kind of where I was trying to do that because I want to get as much in as I can. I'm trying to see if I missed anything. No, I think I covered a lot. Gay and Kyle, they're not going to talk about LIBOR. They're not. I can't. If they did, I'd be very surprised. Very, very, very surprised. Again, it seems like Wednesday's always a bad day. I just came back from Texas. I flew out yesterday, flew back this morning. Got to see Waco, got to see a lot of stuff. And got to see longhorn cattle, big horns. It's great. Texas Longhorns, hook 'em horns, right? Okay. Anybody have last minute stuff? If not, I'll head out and I'll see you guys all next Wednesday. Again, listen, if you like what I'm doing, please subscribe. Please like my shit. I like the little buttons. That's, again, I have pretty arrogant and I'm trying to help people. If you're in a big class, please share this and tell people to look at my stuff. I make money tutoring, so this is not tutoring. So I'm just trying to help people out, but I do get some business from this. So some people reach out to me. So please tell me. And as long as I keep going up, I'll keep doing it because I don't mind doing it. And it makes me feel like I have friends. I'm totally kidding. Okay. No, I don't have the acronyms. I'm going to finish with the 3 stages of money laundering. And if it helped, go watch the show Ozark on Prime, on Amazon Prime. That's all about money laundering. Okay. So yeah, so Noe, make sure if you have STC, I don't know who said you were using, but if you have STC, if you can borrow it, yeah, borrow that STC book and read the maybe I'll try to do one Tuesday night. I usually do Wednesdays because that's a light night. For some reason, it's a light night for me. And my son plays lacrosse, and what happens is he plays on Tuesdays and Thursdays, so he's at boarding school. So they Wednesdays are usually good for me. Greatest sport in the world, by the way. Money laundering. I'll talk to Jason. Do me a favor, shoot me an email, and I can tell you what I got. I'm pretty available. I'm a compliance officer for a broker dealer, but most of the stuff's on autopilot anyway. So I'm a busy man, but I have time. Any money laundering. So what happens is we come in, and it's basically the placement. The placement is when they're giving you the money. That's why they have SARs and stuff like that. So we have so you put the money in, like some guy walks in with a suitcase full of bloody cash. Sorry, but or a big suitcase of cash. You got to ask him a question. Where'd you get the money? And he go, where'd you get the cash from? And if he goes, and he starts stammering, well, you're gonna follow CTR first of all because it's over 10 grand. Okay. Yeah, I'll try that before I go. Now, that's the placement. And that's where most of them get caught. So it's placement, layering, and integration. So placement is putting the money into the system, like putting it with us. And that's where it's easy to get caught. Some guy walks in, he puts in 20 grand in cash. You're putting dirty money in, dirty money into our broker dealer. Then layering is him wiring it to a bunch of different countries. I don't want to be a certain way, but there are certain countries that are money laundering havens. Isle of Man, Cayman Islands used to be. So if you see somebody not caring about commissions and just walks in and starts wiring like crazy, it's a red flag. It doesn't mean he's a terrorist or a money launderer, but it's a red flag. Then the next part is integration. So let's say he puts 50 grand in cash and then he wires it to Isle of Man, then Cayman, then Afghanistan, then England, then Philippines, and Australia, and comes out in Bahamas. And then he's standing there in Bahamas, the money gets wired to a bank account there, and he pulls it out and starts spending it on stuff. That's integration. So it goes placement, putting it with us, layering, put some distance between it, and then integration. Okay? Real quick, when I went to school down in South Jersey, I worked at a casino. And this is the funniest, this is the early 80s. That's all, no, mid 80s. Nobody thought money laundering was for terrorists. They thought it was for drug dealers. So a guy walked in every Tuesday night, would drop 5 grand on red. And this is the 80s. 5 grand's a lot of money. And he'd win or lose, and wouldn't blink an eye. He went to like 5 different tables in a row. He would bet red on every one. And sometimes he win, sometimes he lose. And I go, why doesn't the guy care? And why didn't he stay here? Because he's putting cash down on the table and receiving chips. So if he wins, he gets chips. And at the end, he just cashes them out and has new clean money. So they knew then. The pit boss said to me, oh, don't worry, he's just laundering his money. They didn't care. Nowadays, it's ridiculous because it's terrorist financing. Okay. Now, last thing I'm going to do, then we'll figure it out. Okay. Hedging. Hedging is protecting. So let's say I am long 100 shares of 50. I own 100 shares of IBM at $50. I want it to go up because I'm bullish, but I'm afraid it'll drop to 0. So wouldn't it be really nice if you had a piece of paper that said, Edwin, oh, you bought stock at 50, but this piece of paper says you can still sell stock at $50, even if it goes to 0. You buy 100 shares at 50. You have the right to sell 100. You bought the put, which gives you the right to sell at 50. Say you paid $1 for it. If the stock goes to 0, yeah, your customer's calling you up going, hey, Edwin, you're the worst. I lost all my money. And you go, relax. Stock's at 0, I know, but I still sold it at 50. So you only lose $1, what you paid for this thing. This is hedging is when you buy options to offset a position. So remember this, if you're long stock, you buy a put to protect or you sell a call for income. Write that down. That is gold. If you're long stock, you buy to protect, buy a put to protect, or sell a call for income. There are no other choices. You don't buy stock and buy a call. That's 2 buys. Why would you do it? So if you're long stock, you buy a put to hedge, you sell a call for income. I'll do the income next week maybe. Short, and it should be in one of my videos. Short stock, and there's a million of YouTube videos talking about options. I'm just trying to get you through this exam. If you short stock, shorting is borrowing shares. You want it to go down. You're afraid it's going to go up. So if you short 100 shares at 50, you're worried that if it went to 70, you have to buy it at 70 to give it back. So the whole thing is, if you're short at 50, you would buy a call so that even if the stock went to 70 or 80 or 90, you can still buy it at 50. You don't care. That's the magic of hedging, is that you don't care where it goes. And you still lost money, but not a lot. Kind of like this. All of you, if you don't live in a city, you may have a car. So if you buy insurance, that's what you're doing. Say you have a $10,000 car and you buy insurance so that if the car crashes, the insurance company will give you 10 grand. Very much like a put. You have the right to sell it to the insurance company for 10 grand. So do you want to use it when you have your car? Do you want to use the insurance? You do not. It means you lost money, but you lost less than you would have. Edwin, I hope that helped. Again, long stock, I buy it at 50. Okay. You buy stock at 50. You want it to go up. You're afraid it's going to go down. Thanks, Zach. Tell people that I'm the man. I want a lot of viewers. Because I can charge YouTube for that. They'll pay me. Then I have to charge. Okay. Listen, I hope it helped, Edwin. If not, shoot me an email. Listen, I'm going to head out. It's about 9:39 here, and I am super tired. Have a good night. I'll see you all Wednesday. Maybe I'll try to do one Tuesday night before this. You all have a great night. And this should be reposted. I think they're within about 20 minutes, all right? You all have a good night. See, I was in Texas. I started talking like y'all. Okay. Surprised I don't have a cowboy hat. I love Texas. If anyone's down there, I'm not making fun of you. I love the place. Good night.